Hello everyone, today I'm going to be showing you 5 undervalued stocks that I believe the market may have all forgotten about. These are high quality companies despite their current share prices and actually undervalued given their current financials and historical metrics. So I'll be going through them with you guys today in as much detail as I can. The first stock that we have is Mercado Libre, and I've talked about this one a fair bit, but despite its impressive run up year to date and sitting close to its all-time highs, I believe according to its fundamentals and what you are getting for the share price, it is undervalued. Mercado Libre is an e-commerce company that operates mainly in Latin American countries like Mexico and Brazil. And it has returned massively to shareholders over the past 5 years, up 156% in the past 5 years and 27% in the past year, outpacing the S&P 500. And I recently opened a position with them, so fair warning. This company is similar to Amazon in its scope of coverage and network, offering first and third party product sales online. This marketplace already has a massive exposure with a consistent growing amount of unique buyers that goes all the way up to 85 million in 2023. But unlike Amazon, instead of using this network to develop cloud software, they've moved into the fintech business among others. Mercado Pago seems to be the rising star that's attached to this company, producing $398 million in just 2021 and more than doubling that number to $825 million by 2023. That's in just 2 years, which is amazing because now Mercado Pago is responsible for about 47% of Mercado Libre's entire revenue. This is a company that has used its brand to create a highly efficient and impressive growing fintech business that is giving them nearly half its revenue all over again. The financials capture how impressive this company is at making money, with revenue growing at a 50% CAGR in the past 3 years to $15.8 billion, and with a 70% CAGR of year-over-year growth in operating cash flow for the past 5 years. So why do I think this is undervalued right now? Well, if we take a look at the free cash flow yield for this company, that is effectively the free cash flow amount per share that you are buying as an investor, we can see it currently sits at 6.4%, which is very high. And to put it in perspective, right now, if you was to buy Microsoft, you would now be locking in a free cash flow yield per share of 2.2%. So nearly 1/3 of the yield for Mercado Libre. Now, historically, that yield is well below what Microsoft has offered to shareholders if they had originally bought. So that is maybe a bit more of a reason for Microsoft being overpriced. But back to Mercado Libre's case, this free cash flow yield is just getting better and better each year. So the growth of free cash flow is effectively outpacing the price and share price appreciation that we're currently seeing, despite it being up nearly about 27% for the year. Perhaps that is why we see massive upside from Wall Street with very little downside, with their lowest forecast price target representing a 14% upside at $1,807, with a high forecast of around 50% up from the current share price to $2,385 per share. Their recent slight dip puts them down over 5% in the last month, so it may be one to watch. Next up, we have a software financial company that has produced great returns historically also, down nearly 10% in the past month, however up 27% over the past year, and up 123% in the past 5 years, to a current share price of around $566 per share. Intuit is a software marketing company that offers products for accounting, payroll, and tax for small and medium-sized businesses. Their products include TurboTax and QuickBooks, which are supposed to make accounting and bookkeeping simpler for businesses to process and keep record of. They have maintained a dominant market position in this space, with TurboTax accounting for over 70% of the tax market share in the US. Now, this company's financials represent the profitability and growth that this company can offer, with revenue up around 19% year over year in the past 5 years to $15.8 billion, and their net income increasing 14% year over year for the past 5 years to $3.1 billion. And finally, of course, their free cash flow, which has been growing impressively as well and reliably to $5.1 billion in April 2024 at a CAGR of around 18% for the past 5 years. So why do I think it's currently undervalued? Well, there's a few reasons, but given the more recent dip below 9% over the past month, this one's share price now puts it at 31 times price to free cash flow, below the average price to free cash flow we've seen with this company of 36. With a free cash flow yield now that sits above 3%, which is above the average, which currently sat below it. Wall Street have this one at over the next 12 months an average share price of $726, representing a 28 upside, and a high price target of $808, so 43% upside. The next one I couldn't get away without mentioning in an undervalued stocks review, which is of course Salesforce. Down close to 6% year to date and over 13% in the last month, is currently priced around $240 per share, so it's had a recent sell-off. For those that don't know, Salesforce is a customer relations management company, in basic terms, tracking customers for businesses to help their relationships. This helps companies keep tabs on customers' payments, subscriptions, all the way through to their messaging and history, which effectively helps companies tailor their business to their customers and allows for specific tools to improve the customer experience held on the subscription software that Salesforce provides. They've had consistent growth across the world from this strategy, and subscription-based model that they offer means that they've grown their free cash flow at impressive rates so far year over year. Currently, their top line revenue has shown impressive growth, up around 21% year over year CAGR for the past 3 years to $35.7 billion. Meanwhile, their free cash flow has been even more impressive, with 28% CAGR over the past 5 years to $11.3 billion. That's more recently they've started to use to pay a dividend. To me, they're undervalued because they've traded as low as free cash flow yield of 1.8% in the past, but they currently sit at 4.8%, well above the average yield per share of around 3.3%. So historically, just according to those metrics around free cash flow, that is undervaluation. This puts the price to free cash flow of around 20 times rather than around the average of 31 times. Additionally, over the next 12-month period, Wall Street analysts have an average price target representing around a 27% upside to $308, and Morningstar have a fair value for CRM sitting at $285, which is still a high amount of upside potential for this stock. The next stock on the list is one I've talked about in the past, but I currently don't own, which is of course MSCI. This is a high quality analytics company that is a bit down on its luck still, up around just 2% this year, trading the market gain of the S&P 500 by quite a bit, and is still up 105% in the past 5 years. Morgan Stanley Capital International is a leading provider of risk assessment, research and analytics tools, offering loads of indices to match markets for customers and offering insight from 50 years of research into markets. They have an established reputation among banks, asset managers and hedge funds that use their data and tools to meet their own needs. This predominantly subscription-based service offers impressive gross margins of 82%, and operating margins above 50%, which they use to pay an impressive growing dividend and buy back shares. MSCI has a revenue growth CAGR for the past 5 years, which sits at 12% to $2.6 billion, showing consistently through the years like COVID that they can still prove to be profitable and grow that top line. Their net income sits at $1.2 billion, growing at 21% CAGR over the past 3 years, which all feeds into their free cash flow growth, which currently sits at around 16% CAGR year over year for the past 5 years to $1.2 billion. And finally, they have growing their dividend at a fast rate, currently paying 1.32% starting yield, growing by 16% in the last year. And they've been aggressively buying back shares from outstanding share count of around 117 million to now close to 80 million. So why do I think it's undervalued? Well, their free cash flow yield per share is now sitting at its highest point of just over 3% in the past 2 years. And that puts it at a lower price to free cash flow than the average for this company. It currently offers a 32 times price to free cash flow over the average of around 42 times. This is another one that Wall Street analysts don't see any downside for the next 12 months, giving an average price forecast of $566, so 17% upside, and a high forecast around 38% upside for the current share price, sitting at $669. Now we come to the last stock, which is another one that I do also own, which is down quite a bit this year along with the rest of its sector, which is real estate. Vici Properties and other real estate trusts are highly leveraged businesses that rent real estate to tenants and are currently in a high interest environment of the economy, with rate cuts planned this year but not yet materialising. Vici is currently down over 12% for this year and only up 23% in the past 5 years, not including dividends reinvested. Despite this, Vici, which owns high quality real estate predominantly along the Vegas Strip, has done very well and could do even better in the future despite its share price at the moment. They currently have a 33% CAGR in revenue over the past 5 years to $3.7 billion and a price to AFO sitting just below 13 at 12.76, which is a lot lower than its peers. In fact, their adjusted funds from operations per share over time has increased substantially since 2017. However, the share price is only up 23% in the same time frame. They additionally grow their dividend at a rate over inflation, raising it 6.4% last year, and has a history of doing so, now offering an impressive starting yield just below 6%. This stock is undervalued like most in its sector, but when compared to its peers, it might be even more so undervalued. For example, Extra Space Storage sits at a price to AFO multiple of over 19, whilst Digital Realty Trust sits at a price to AFO of 23, both well above Vici's P to AFO of just over 12. Personally, I believe this high quality REIT, which has 30 years or more of its tenants' contracts with MG Grand and the Venetian, will do very well when and if we see interest rate cuts in the future. But thanks for watching, guys. I do appreciate it, and I will catch you in the next